In 2026, meteorologists expect a high probability convergence of a severe El Niño and a positive Indian Ocean Dipole. In a highly integrated economy, record-breaking heat functions as a direct catalyst for systemic financial disruption. To survive it, we have to model the exact financial damage of this multivariable anomaly across entirely different industrial sectors before it happens. We must translate raw meteorological data into a precise, predictive macroeconomic stress test. Forecasters use this specific tool, the Sectoral Economic Impact Estimation Table, to quantify the upcoming damage. This chart shows the massive variance in their projections. The baseline scenario projects a total GDP loss of 5 billion ringgit, but the extreme tail risk pushes that number up to a 20 billion ringgit worst-case scenario. Understanding that massive 15 billion ringgit gap requires tearing down the model row by row, isolating the specific failure mechanisms. We start with the sector most physically vulnerable to drought. The immediate front line of this impending drought is Malaysia's northern agricultural belt. Water scarcity here causes direct, linear destruction. The Muda Dam, a critical reservoir for irrigation, has dropped to just 7.47% capacity. This forces authorities to trigger dry seeding protocols, a fallback method that agricultural associations warn could lead to an 80% collapse in paddy yield. What starts as microeconomic devastation, individual farmers facing total harvest failure, rapidly scales up into a national food security threat. Looking back at the estimation table, this translates to a projected loss bracket of 400 million to 1.1 billion ringgit for the paddy sector alone. For staple crops, meteorological water scarcity directly and proportionally destroys economic value. It is a purely additive loss. But the calculation changes completely when we look at Malaysia's primary macroeconomic export, palm oil, which accounts for 12% of total national exports. Oil palms are highly water-dependent. The prolonged drought will induce severe water stress, leading to a biological lag where fresh fruit bunch yields drop sharply 6 to 12 months after the heat peaks. This graph shows the counterintuitive mechanism. As domestic yields drop, global supply contracts. This forces global prices up. TA Securities projects prices surging to 5,500 ringgit per ton. This creates a negative indirect loss, a buffer of up to 1 billion ringgit, offsetting direct destruction. Agricultural crop failure does not automatically equate to macroeconomic collapse, provided the commodity commands global pricing power. The secondary economic shockwave moves beyond agriculture into the national utility grid, driven by rapidly evaporating reservoir levels. This chart tracks Malaysia's 43 national dams. Already, 10 of these critical infrastructure nodes have dipped below the 70% critical threshold. This exposes a severe vulnerability in the energy grid. Hydropower output drops proportionally with reservoir levels, forcing utility companies to pivot to far more expensive gas or diesel generation to maintain the baseload. This substitution cost injects hundreds of millions of ringgit in indirect inflationary pressure across the entire economy, raising production costs for every sector. At the micro level, municipal water rationing directly disrupts the labor force, draining daily operational efficiency as basic human needs take precedence over industrial output. Utility failure acts as a silent inflation multiplier, taxing the broader economy just to maintain baseline functions. This brings us to the critical sector that determines if we face a manageable 5 billion ringgit loss or a 20 billion ringgit crisis: semiconductor manufacturing. Malaysia houses a massive concentration of the global semiconductor packaging and testing supply chain. These facilities require millions of gallons of ultra-pure water daily to wash silicon wafers. This network links dam reservoirs to industrial nodes. As drought stress turns water reserves red, the supply chain faces delay risks. During 2014 water rationing, manufacturing losses exceeded 1 billion ringgit. Today, production volume and reliance are significantly higher. Industrial water insecurity, forcing factory idle times and destroying global output, is the definitive tail risk that pushes this forecast to the 20 billion ringgit extreme. A positive Indian Ocean Dipole triggers massive open burning across the neighboring Sumatra and Kalimantan, severely complicating the crisis. This creates severe transboundary haze, blanketing Malaysian cities in toxic particulate matter and creating an immediate public health hazard. The economic contagion of the smoke immediately hits the service sector, It grounds logistics, spikes healthcare expenditures, and forces mass cancellations in tourism. The positive IOD acts as an uncontrollable external multiplier, economically attacking the urban and service sectors that would otherwise remain largely immune to localized drought. The scenario comparison matrix reveals the full threat profile, bridging the gap from the 5 billion base to the 20 billion worst case. Hitting that boundary requires the simultaneous failure of water reserves, energy grids, and transboundary haze shutting down tourism. To prevent this convergence, the government is executing a proactive fiscal mitigation strategy, spearheaded by current policymakers. The 2026 budget deploys highly specific interventions, 2.4 billion ringgit allocated for smallholders and plantations, alongside a 1.6 billion ringgit food security fund designed to buffer the supply chain. These allocations mark a strategic move towards systemic climate-economic adaptation, utilizing carbon taxation and climate-smart agricultural tech to build physical buffers. Ultimately, economic resilience is a system designed to intentionally absorb, distribute, and completely stabilize against massive external shocks. In an integrated global economy, extreme weather operates as a rigorous macroeconomic stress test, where national survival depends on proactive fiscal buffering and infrastructure redundancy.